Hello, everyone. This is a Saturday, 3 p.m. Remember, we talk about business. Isn't that boring? And I suppose you should be doing something more fun than learning financial stuff. But this is a fun stuff, I'll tell you. And in my, if you see the push out we have related to today's webinar, you realize that we're talking about financial statement, but this is the kind of shit people don't want to talk about, right? It's just so foreign, and you only hear that when you go to get money, you want to loan money from the banker, and they tell you that, oh, I want to see your financial statement. Then you go, oh, sure, I have it. Here is my total income, that's my expense. Here is my profit. And what else you need? Then the banker goes, oh, I want to see your balance sheet. And, I had one client told me, saying that, Ying, what do you mean by balance sheet? I don't have it. And I'm not balanced at all. My life and the business are in the chaos. I don't want to deal with this shit, but my banker wants it. So here you go. And we need to talk about why they want it. So you think properly. That's a balance sheet, not the other word around. And Catherine already told me, don't say those words on internet. Those are not good words to say. I am just giving you reality show. There's no secret, right? We all live in reality. So this is our firm. You are looking at a screen. That is our website. And on our website, you actually can see what is coming and for the webinars. So I hope you enjoy seeing that. And at the same time, I also want to show you that we have a YouTube channel. Yes, if you tell me that you didn't even know we have a YouTube channel, come on. I need to take you out for coffee and make sure that you know how to log on to Community CPA YouTube channel. We have all of these videos that we collected for you over years. And of course, some of the content is kind of outdated, but look at this one, recession prevention, right? And I just did last week, I did on Tuesday, I did a talk about cost segregation. Those are kind of related. We talk about prevention for recession. One of the cure for recession is you buy property in a good deal, right? So when people are losing their jobs and missing out making payment on the property, if you have cash on hand, you're going to take advantage of that. Because of that, and property purchase is a thing during the recession. And when you want to purchase property, you literally deal with the banker. When you deal with the banker, you literally think about financial statement. That's why we are here today. And I want to, I didn't really prepare a PowerPoint for you today because I really want you to just be with me. And we talk about financial statement. I will draw that for you. And I'll tell you a secret about myself, other than I am sitting on the National Taxpayer Advocacy Board and, advising IRS. I also have a secret hobby. And I used to be, when I was a teenager, I thought I would be an artist because I was painting really heavily, and I do very good painting at that time. So one of my painting is even went to France and bought by a doctor in France, and when I was little. So I like to draw. After, I went to college, my parents told me that don't be an artist because you're going to be a starving artist. So I sort of like listened to my parents and I went to business school. Here I am talking to you about accounting. But one thing about me is because of my art background, so I sort of like things to be more visual. I don't mind to read, but to have something visual will imprint in my brain really well. That's why when I meet people, even if I don't remember your name, I would remember your look because I understand, I somehow imprint you in my memory. So I always know this person I met before. So having said that, let's go for the real stuff. And I am going to bring up the whiteboard to show you what we need to do in terms of understanding financial statement. This is my whiteboard, folks. You're with me, right? And, let's say today is May 14th. So I hope you read my writing. So confirm that you can see it. So today we're going to focus on this whiteboard. And I want you to understand the financial statement by me drawing you boxes. Very straightforward. So I have two boxes I'm going to draw. And my lines are not very straight, but that makes it interesting, don't you think? And I have two boxes here. Imagine these are two pieces of paper. And one piece of paper is what they normally call income statement. There's another name to it, right? Profit and loss statement. If you use QuickBooks, they call that profit and loss. But if you use other professional software for accounting, they call that income statement. So it's the same thing. Inside of income statement, you actually have three components. Yes, three components. All right, so let's look at the next one. The next one we're looking at is a balance sheet. Balance, S-H-E-E-T, not S-H-I-T. All right, so inside a balance sheet, folks, there are three components too. See how similar they are? They are just like that, right? So when you have an income statement balance sheet, you look at three components on each of those paper. So on income statement, the first box we have is what? Income, sales. And these are the money that came to your bank account. They are money increasing your bank deposit. They're increasing your bank deposit. They are your income coming from your customer. Right? So that income minus expenses. So in here, remember, we also have expenses called cost of goods sold, right? You know, a lot of time you see the income statement kind of split it out, has a cost of goods sold in the separate boxes. So I want to give you a understanding right here, okay? Just give me a moment because I want to change the color of my pen because that cost of goods sold sometimes is right here. But I want you to forget about that for right now because it is still expense, cost goods sold. It is still expense. They just want to introduce a new concept right here between income and the cost of goods sold. They want to introduce a new concept called gross profit. So what is gross profit? Gross profit is your profit before overhead. So they want to call your other expenses inside of here are overhead. So for the simplicity, we're just going to call that all expenses. So our expenses reduces the bank deposit, right? You agree? Reduces bank deposit. And paying to who? To the vendor. And also paying to who? To your employee. And also who? Contractor. Who else you gonna pay to? Nobody. That's what you're gonna pay to, okay? Your vendor could be the bank because when you pay interest, you pay to the bank, right? That's your vendor. So here in the expense is everything about what you pay to the customer, pay to the vendor, and pay to employee, and pay to contractors. Now, your income minus expense equals to what? Profit. So this is your income statement. Who doesn't understand that? You do. But not everybody understands balance sheet. Now let's dive into balance sheet. So we understand the profit, right? So if you run your profit, if you run your balance sheet from January 1st, 2021 to December 31st, 2021, this profit representing at the end of the year, what you pocket to your pocket, right? It's representing the money you made as a business owner, you made out of this business. So let's look at the balance sheet. The balance sheet is asset being the first box. But what's in the asset, folks? What's in the asset? Your bank account. Of course, when you have a business, you have bank account. So the money in the bank account is your asset. Yeah, it is the money you have, right? Then what else is asset? Inventory? Yeah, sure. And what else? Your car, your vehicle, and your maybe it's your building because you're renting it, right? So asset, fixed asset, right? Asset. And what else can be in the assets? Account receivable. The money you already issued invoice to your customer, but they did not give back to you yet. That's account receivable. Or you take company check, wrote a $50,000 to your brother-in-law, and your brother-in-law owe your business. That's account receivable, right? These are your assets. The asset simply means something you have, something you use, something you have possession to. Asset equals to what? For anything you have, you either made it because you made money, so you have that, or you got it, you borrowed it. Am I right? Look at anything in your life. You either made it, is yours, or you borrowed it. Just like my glasses on my face. Okay, this glasses is my asset. I have these glasses. It cost me $1 million. No, actually just 1,000 actually. Yeah, it's a Tiffany frame. Actually was hurting my nose today, but it's a Tiffany frame. So it's $1,000. And I paid $500 in cash. That was my own money, so I paid it. But I paid the other $500 on credit card. What does that mean? That means this glasses asset for $1,000 and the $500 is the loan. So here is the liability. The other $500, where is that come from? That comes from out of my pocket, from here. That's my equity. This is my equity. Okay, ladies and gentlemen, I want you to realize that the balance stuff, the balance sheet, it is made up by asset and then breaking down to how you come up with the asset. If you have a car, then the car is $100,000 and you borrow the whole $100,000, then your liability will be $100,000. But your liability plus your equity, that should equals to your total asset. So now you're gonna say, well, we were talking about lending, getting money out of the banker. Why are you talking this? The reason I talk this, because the bankers knows so much about this balance stuff, the balance sheet, because the banker want to see what? Liability being zero and equity being everything. So if you got a vehicle for 100,000, say right here, you had a vehicle for 100,000, and you got loan being zero. What does that say? Your liability is 0. That just says that you are so great and you bought the car on your own without borrowing money. So you must have enough money in your equity. Otherwise, you cannot balance this balance sheet. The balance sheet is about asset balance with whether you borrowed or you have it, right? So now we understand the balance sheet. 3 components, total asset equals to liability plus equity. So now you're gonna ask me, oh, where is the equity come from? Do I just put in $100, $10,000 like that? And I mean, equity has to be coming from somewhere. Yes, equity come from 2 sources. Equity normally come from the profit you made plus your investment. For example, when you just set up a company, and when you just set up a company, you haven't even made any money yet, but you set up a company. So you put in the bank account, maybe you goes, my bank account balance, let me clean up the numbers right here. And maybe you say that, oh, I'm setting up a business yin, and my business is going to be a construction company, and I put in bank for $1,000 cash deposit. And so what is my balance sheet look like? Your balance sheet look like asset for 1,000 that equals to your investment of 1,000. So a year later, and you made money, and you made 20,000 profit right here, then your equity would become 20,000. And your bank would increase 20,000, right? Because you made money. See, it is balanced again. It is 21,000 balanced with 21,000, right? This is how you balance your balance sheet. Now, when you want to buy a property, okay, we're gonna use a different color to draw our property inside of here. I'm going to use orange. So let's say we decide to buy a building, and we want the banker to approve our loan for the building. We look at a building. Oh, we like it so much. And this is a multi-tenant apartment building, and it cost $2 million to buy. And in my bank account, on my personal side, I have about 500,000 cash, you know, from my spouse. And, you know, I'm in business. I'm the poor one. My spouse has a regular job, and, you know, he actually makes more money than I do. And he said that to give me 500,000 to as a down payment. So we have a down payment. $500,000. Okay, so where is that down payment coming in? Because you are buying the property under the business name, so your spouse would have to invest 500,000 in here as your equity and increase the bank balance by 500,000 because the money has to come in, right? So this is one transaction you did by putting your personal money into the company, counted as an investment. Okay, count as a paid-in capital. Now, you got 500,000, so you are asking bank to give you 500,000 loan. So the bank wants to make sure that you can afford this loan with a rate of 5%. So let's just do that calculation. And in a year, if it is 5%, and you would need to come up with interest expense, then you have to, it is interest expense for you, right? For the bank, it is their income, right? Because they're charging you 5%. So I'm going to put 5% here. And then that is 75K for a year. So the bank wants to make sure that, okay, I know your building worth 2 million. I already did evaluation. The bank goes, that building is 2 million. You put in 500,000, we loan you for 1.5, and it is 75,000 interest expense. We want to make sure that you can afford it. That's what the bank is thinking, right? And then the bank also asking, do you have other loans already? And you may say that, oh no, I don't have other loan. So then they will just look at the 75K. But what if you do have other loan and you have a liability number here from other properties you have in the balance sheet? So maybe your inventory was 200K, but you borrowed the whole inventory amount. So we have 200K here as a loan. And this is also 5%. Then that means you have a 10K each month additional expenses. Then the bank would add these two together. So whichever number the bank came up, they know that is your everyday payment you need to come out. So the bank will look at here where you have to see whether they can see the 75K additional expense is okay or not. So you see how the thinking goes on the bank side. So they want to make sure the property has a value. In case you don't pay, they sell the property, they get their $1.5 million back. You're gonna lose your down payment, but the bank not gonna lose their money. Okay, so they evaluate the building, then they know how much you put in, then they look at your liability in total, figuring out how much expenses in addition to what you already have here. In addition, okay, so now if you say, well, my net profit after income and expense is actually a 200K net profit, then that would give a bank very optimistic looking about your 75,000 interest expense. Looks like you should not have a problem. So most likely the bank will take this number and go back to 2020 and go back to 2019. And what they do is they add up all your profit and then add up all 3 years. They divide it by 3. They want to see your average. They want to see whether your company is really kind of that way and can pay the 75,000. So this is where they would look at your income statement. But all of these understanding about whether to loan it to you or not is coming out of the balance sheet. So this is where I want to focus on your understanding of what the bank does for you. And if you want to have a successful lending going on and be able to borrow the money from the bank, of course, when you buy this building, you can't just assume that you are good. You're going to be putting on the condition saying that subject to financing. If the bank finance me, I buy you. Otherwise, goodbye, $2 million property. I can't afford you, right? But let's say you have that contract already. The bank already evaluated building, goes, oh yeah, $2 million, no problem. And then you put in 25%. Actually, no, you put in 20%. You put in 20%. Is that 25%? So 500,000 is 25% down payment. That's pretty good. So the more you put in, the easier bank loan your money, because if you default, they sell the building, they're not going to care what you put in. They're just going to be focused on their 1.5 million. They want to make sure they get that back, right? So now you know how they calculate the interest expense. Then they want you to have enough income on the income statement to meet their needs. With this kind of underwriting, with this kind of understanding, then you actually know what you need to see on your balance sheet and also on your income statement to get that loan approved. You are halfway underwriter yourself, right? By understanding that. So to recap what we talked about on the balance sheet, because of balance sheet is a balancing act between the equity, between the asset and versus liability and equity. So you want your liability to be as little as possible, squeeze that to zero, then you have your equity be fat. And one good example is that we have a client, and under their liability, they have an amount they owe to their mom. Because when the business started, mom put in the money and they laid that out as a liability. Understandable, because mom loaned money to their son, and it's not like never heard of. And in fact, I have not seen any mom who doesn't empty their pocket for their very naughty kids. You know, it doesn't matter how bad they are, they all do that. All the mom do that. So there is a liability under the mom. And when the business go for the loan, the bank was really concerned. The bank goes, "Ooh, I wish that you don't have this liability. And, you know, how did you pay your mom back? What is the rate?" And our client goes, "I never pay my mom back a rate. I never heard of it. My mom just want the principal back." Oh, okay. And so I went to the client, goes, "Really? Your mom want principal back?" Client, "Oh, no, not really. My mom probably don't even remember that anymore. And she started developing dementia." All right. So can you just tell your mom that, "You know, mom, and I'm just not going to pay you back on that anymore. I am going to move your liability to me to become the investment. Increase my equity." So this is what I mean by squeezing your liability. Squeeze it and see whether any of those debtor you have can promote them to be the investor. That is one way for you to get a fat equity, a thin liability. And being fat in equity will guarantee your success in lending, in borrowing. All right. So much about this. And in this time, I also want to share with you another very important thing, very important. And I promise you that this is the most important class you should take when it comes to financial statement. I am serious. Let me use pink color to represent your dear auditors from IRS, auditors from your investors, anybody who wants to audit you. And I want you to understand what that is. Okay, let me just make sure. Because I see on my screen something I want to get rid of. Oh. Okay, folks. Let me just get rid of something on my screen. You may not see it, but it's blocking my view. So I'm taking that out. Hopefully it will go away. Yes. Okay. Now I am going to my pink pen. I'm going to talk to you about the auditor. And when you get audited, and the auditors, especially the IRS revenue examination auditors, they want to see your income more. They want to deny all the expenses because they want more profit to show up here. The higher the profit, folks, the higher the taxes, right? Income tax. So the game is look at your income to raise it up. Look at your expense to bring it down. Very simple, right? You know, it's almost like we're done with this talk already. You know what audit means. Bring your income up, bring your expense down. Okay, what are the things they do look to bring your income up? Folks, what else might be your income? And I am going to circle a box for you. And you're going to be surprised. You're like, what, Ying? Why are you circling liability? Do you know liability increases your bank? When you borrow money, the money went to your bank, right? When you get money from mom for $200,000, mom wrote you a check. and they increased your bank deposit right there. And how do the auditor know it is mom's loan? It is not your income. The only way they know it, it is you having that 200K properly documented under liability. Then you can go away from that assessment because this whole box can be brought to your income. If you have $500,000 on liability, your whole $500,000 can be potential income that IRS is looking at. So this is why when you are being audited and they want to see your loan notes, you go, wow, that deposit is not my income. And my friend, they just gave me $20,000 for fun. And I loaned that money from them. And the revenue officer would ask you, do you have a loan note? It's not because they want you to produce paper documents. They just want to know that what kind of things you have to prove that is the money you loaned from your friend is not your income. Maybe you did some drywalling for them and they're paying you. And you just want to say it is not your income. It's actually, it is your income. You see how this liability is really look like income, right? So that's where, and you want to be aware what you put in the liability that can be easily viewed as income. And maybe in one of those years, your accountant did a income statement for you. You were like, no way, I didn't make that much money. This is wrong. And maybe what was wrong is the deposit for the loan become the income. And in 2021 and 2020, a lot of things were wrong. People are putting PPP, RF, ERC, they are putting all kinds of things under income. That's wrong. That's not where it goes, right? So this is where you want to make sure you understand your income right here, my dear, is kind of look like your liability. Now, let's talk about expense. Remember, the revenue officer will try to increase your income so you can pay more taxes. They will try to reduce your expenses so you can pay more taxes. But how do they reduce your expense? Let's say you're so good. You got all the invoices lined up, perfect. But you have a big equipment you bought and you are putting it on the expense. And the revenue officer goes, oh, no. That is an asset. That is an asset. And it should come out of here. So your expense, so that asset is 35K. Okay. So that is not your expense. It should come over here as 35K asset. When they take that out of your expense, put on the balance sheet, your profit increased by 35K. You understand? Because they suddenly went away from your income statement. The taxes is calculated by income statement, folks. They're related to the balance sheet, but taxes is calculated under the profit right here. So by removing the $35,000 equipment to asset, yeah, you're reducing expense, then you're paying more taxes. Of course, you go, oh, hold on, Ying, you are not right. You know, I did put that under the asset, but somehow it is still expense. Yes. You were using bonus depreciation, got your 35,000 under asset, then you depreciated out as a full amount. So it came back as a depreciation. But it is not expense as equipment. It is expense as a depreciation, right? So totally understandable. But then again, your revenue officer and not necessarily would know what kind of depreciation method you're using. So they don't have to give you bonus depreciation if you are misclassifying it as an equipment deducted over on your expense and you did not go to asset, then move it back in. So this is just one example. One example of your expenses that could be considered together with your asset. What about the inventory, folks? Right? See how asset related to expense, liability related to income. And this is a play. When you get audited, these two boxes on the balance sheet plays a big role. And do you know that? And I had a webinar talking about inventory. And I want you to just memorize that. You don't have to understand why if it is too much twisting around. Just understand the higher value you have on inventory, the higher taxes you pay. Why? Because the more you put in asset, the less you put in expense. So because these two boxes, this expense box and asset box, they are kind of in the same nature. If you move your expense to asset, the more asset you have, you don't expense it, then you pay more taxes, right? That's why it's higher inventory, higher taxes. Lower inventory, lower taxes. That's why I always tell my client that at the end of the year, I don't care how your impression is. I don't care you tell me that I think my inventory is 5,000. No, I want you to do physical inventory count, because that is the only way for us to feel, yes, that is just what it is. That's a physical inventory count at the end of the year. If it is $0, then everything is expensed out. If it is $100,000, fine, that's on my asset. So I had this 100,000 expense really, but not deductible because they are my inventory, not yet expensed out, right? So this is where you want to understand. See how useful that is to understand this kind of SHIT and balance sheet versus our income statement, right? And I want to conclude this talk right here because I really want you to focus on what I was talking about and see this chart. And I want you to look at the chart again. Close your eyes right now with me. Income statement, 3 pieces. That is the income, expense, and the profit. And income is related to liability because I need to make sure I separate them properly. Expense related to asset, I need to make sure I separate them properly. And on the balance sheet, you got 3 components: asset, liability, equity. And liability plus equity equals to my asset. No argument about it. Our life is like that. Even my glasses on my face is like that. So what else is not that way? And sometimes, you know how we like people in our firm, when we have professionals who also speak another language, I always say to folks that your accent, the English accent, and your ability to speak another language is asset to us. But in some business, maybe that's a liability. If you are in the business that people are very sophisticated, English is so key, and you speak with accent, that may be a liability. So in our firm, the language speaking, the ability to speak another language is asset for the firm. So see how liability asset can be interpreted into life so deeply. It is even in the practice, right? And so I want you to understand your business in this kind of pattern, in this kind of views. Look at everything you have. And the only way to have it is either liability or equity. You either own it or you don't because you borrowed, right? And then asset is asset. Asset is easy to understand and you can feel and touch and a lot of things and you can see it there, right? So that gives the whole general understanding of financial statement. See, our topic is understanding financial statement. And I think I made you understand what banker is looking at. That's your orange piece. and that made you understand what the auditor is looking at, that's a pink pieces. And the blue bottom is just the structure of the two statements. All right, let's conclude. And you can always contact us at Catherine@communitycpa.com. All right, and that's, Catherine spelling with a C. And you can also give us a call and email me. And my email is ying@communitycpa.com. If you have any topics you want us to talk about that would make you better and make you a better business person, make you understand what other people are doing, and you contact us. And our job here is to spread the knowledge so you are as good as who we are, because that's what we do. And yes, Community CPA helps client, but our other biggest agenda is to spread the knowledge so people understand the accounting financial side of world deeper, wider, and you can make a better decision for your business and for your family. And I will see you again, always, twice a week, Tuesday and Saturday. Bye-bye.